Welcome to the Bogart Effect, a wealthy wisdom podcast. The following Bogart Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from Bogart or another investment professional. Please see important disclosure information at the end of the presentation. Hey, good morning. Welcome to the Bogart Effect. I've got Mike Camara with me, and we're going to talk a little bit about pre-tax accounts versus post-tax accounts. So thanks, Mike. Appreciate you joining us.
Yeah, thanks, James. Glad to be here.
You know, this is one where I think a lot of investors get confused with the naming and the nomenclature, and then ultimately it becomes paralysis from doing anything. And so, I think it's a productive conversation to have. And I think to set the stage of this whole pre-tax versus post-tax conversation, we really need to define the different types of accounts. And so I always kind of take it up to a very macro level. And I think of there's three types of accounts, and obviously there's more than that, but at a really high level, there's three types of accounts, which one would categorically be described as non-qualified accounts. These are brokerage accounts, right? These are checking accounts. They're after-tax monies, and historically speaking, they're the last place that we see people actually accumulate wealth when they're in the accumulation mode, simply because you had to earn it, then you had to live, and then you had to save. Now, there are some pros and cons with each of them, and we'll get into that in a little bit. But when we compare it to then pre-tax accounts are any type of tax-deferred account. This would be a 401k, it would be a 403b, it'd be a 457, it would be a traditional IRA. And again, I'm still speaking at macro levels here, but these accounts, you put money in on a before-tax basis, they grow completely tax-deferred, and when you take the money out, you pay ordinary income. And then the last is Roths. And Roths are, let's just say, relatively new in the grand scheme of different account structures. And Roths are, you put money in on an after-tax basis, so you get no deduction. It grows completely tax-free, and as long as you're over the age of 59 and a half and the money's been in there for 5 years, the growth is also completely tax-free. There are some challenges with getting money into Roths. We'll talk a little bit about that today as well. But, ultimately, it's one of these things where when we think about asset accumulation and wealth accumulation, it really is appropriate to have a dedicated and intentional strategy about utilizing all three different types of accounts, not just focusing solely on one versus another. And it's amazing because I have investors who say, well, don't I want everything in Roth? No, you actually don't. And we're going to debunk some of that today as we dive in. So, Mike, why don't you talk a little bit about some of the pros and cons of the pre-tax accounts?
Yeah, absolutely. So the biggest pro to the pre-tax account is that you're reducing your current taxable income in the year that you're contributing. So, obviously you're going to get, savings on taxes with that.
But can we throw some numbers to that? So let's just say you're making $200,000, right? And if you max out your savings for 2026 is $23,500 if you're under the age of 50, right? So that then means that your taxable income drops by that $23,500, which would, in that example, if you're married, that would take you from the 24% bracket down into the 22% bracket by putting the savings into the 401k plan.
Exactly. Yes. And, with that, and if you're even in a higher tax bracket, savings to a pre-tax account or like a 401k comes from the top. So you're saving at the top marginal bracket, essentially.
Oh, such a good point.
The other factor to it, the other pro is that the investments grow tax deferred. So there's a compounding effect that essentially happens with the growth within the portfolio. Think about earning interest on your interest. On a long-term horizon, that's a very powerful effect. Basically, it's beneficial if you expect to be in a lower tax bracket as well in the future. Obviously, we don't know what tax rates are going to be down the road, but I see a lot of people that basically, when they're in their highest income earning years, are still saving potentially on a Roth basis, for example, which is not necessarily the most effective way to be saving when you can be saving that on a pre-tax basis. And again, saving those taxes from being taxed at the top marginal rate there.
Yeah, I want to put a pin in that and come back to that towards the end, because I think that's a great point that I really want to emphasize for the audience today.
Yes, I think, kind of pivoting into maybe like Roth conversion thoughts on that.
Yeah, perfect.
Especially as far as how that goes. And then the negatives to it, like anything, there's pros and cons to it. The negatives with saving on a pre-tax basis is that eventually the withdrawals in retirement are taxed as ordinary income, which again could be at a higher rate if taxes change. You have minimum required distributions with this. So by age 73 or 75, depending on your date of birth, that's going to be where they force you to take taxable distributions from the account. There's less flexibility in tax laws, basically, as far as when you're deferring, you're not eliminating the taxes, you're essentially just deferring them.
Yeah, and the penalties for missing are still pretty steep. So coming back to the point you made about required minimum distributions, it's we kind of call it RMD jail, RMD purgatory, and what we mean by this is that there is a scenario where that required distribution amount is more than you want to spend, which is forcing your taxable income up, and that really is truthfully the negative when you have pre-tax assets that are growing and accumulating, and especially when they perform well, which again, these are great problems. And I would always rather have an asset that I have to pay tax on than not have the asset. Let's be clear. But this is where the optimization work becomes really, really, really important. Some of it is when you're in the accumulation phase of life, as Mike was talking about, where are you saving? Because it is, especially when you're in a higher tax bracket, it is highly advantageous to reduce your taxable income when you're in the upper brackets. And if you're fortunate enough to be in a 37% tax bracket, the reality of it is like the max savings that you're doing relative to your income percentage, it might not move the needle dramatically. But when we talk about accumulation of wealth and how to accumulate and where to accumulate, it's definitely more advantageous to reduce your highest marginal bracket versus paying into it on a very high effective tax rate. And we'll give some examples in a minute. But that required minimum distribution, what happens is these pre-tax accounts grow. And especially if you have other monies to live off of and your taxable income drops early on in your retirement, well, those pre-tax accounts are going to continue to grow. And then all of a sudden you turn 73 or 75 and bam, you're hit with these required minimum distributions. It's important to note, I mentioned that the penalty is expensive. It's 25% of any amount missed in penalty, plus you have to pay the ordinary income on top of that, right? So now that penalty used to be 50%, so they were very generous with the Secure Act 2.0, moving it from 50% down to 25%, but it's still a heavy penalty for pulling money out. The one thing, Mike, I wanted to add that I didn't hear you say, a negative of these pre-tax accounts is that they are, again, designed to be retirement accumulation vehicles. So I view it as a negative, at least, is if you're under the age of 59 and a half, it is a 10% penalty to pull from those accounts. And forgive me if you had said it and I missed it. But it's just something from a mindset perspective. When you're accumulating wealth and putting money into the respective buckets, pre-tax assets and even Roth assets, candidly, they are designed for long-term retirement accumulation. They are not designed for tax deferred for a shorter period of time and then you can pull money out. Now, there are some exceptions for pre-tax accounts, candidly, and also even Roth accounts where you can pull monies out. $10,000 first-time home purchase, medical-related expenses. There's a tax provision called a 72T where you can do a distribution strategy for 5 years of the exact same amount out of these retirement accounts. That'll avoid the penalty as well. So there are ways of navigating the penalty, but candidly, I'm going to tell you right now, these accounts are designed to be long-term wealth accumulation vehicles, really more specifically for retirement purposes. Right. And there are going to be some slightly different nuances between retirement related plans. So for example, 401ks, employer retirement related plans like 401ks versus like an IRA. Well, IRA stands for individual retirement account, right? So these are retirement accounts that are traditionally outside, and you can move money from a 401k to a traditional IRA completely tax-free. More often than not, the reason that we see investors doing that is to get more diverse options from what would have been a legacy 401k plan. That is usually the primary reason. It gives them a little bit more control. It's not always a cost thing. Some 401k plans are extremely inexpensive. Some of the bigger ones, like the government thrift plan, is the cheapest retirement plan option in the country, but you only have 7 investment options, as an example. We work a lot with ExxonMobil. They've got a very inexpensive 401k. However, they can only get 2 trades a month, and you get the average price the following day, and that doesn't work for everybody. So sometimes having that additional optionality by rolling from the 401k over to the traditional makes a lot of sense. All right, I've tangented a little bit. I apologize, Mike. Let's come back and talk a little bit about Roth accounts and some of the pros and cons there, and then we can get into some of the nuances and optimization between them.
Yeah, Roth accounts kind of work in the opposite fashion. Basically, you don't get a tax deduction when you contribute immediately, so you're not saving on taxes now. However, the withdrawals will be tax-free as long as you have reached the age of 59 and a half and you've contributed that Roth contribution at least 5 years ago. So whichever is longer, basically. There's no RMDs for the Roth IRAs. So essentially, you are, again, paying those taxes up front. As it grows, no matter how much it grows to, you're not going to be required to take anything out down the road. Basically, if you're expecting to be in a higher tax bracket in the future, kind of paying the taxes now versus in the future obviously makes sense. I look at Roth monies that basically when you're younger or if you've got kids, typically your incomes can be lower at the beginning of your career, and that's a good time to be putting money into a Roth when you're in those lower brackets. As you get further along, as you get to the kind of pinnacle of your career, eventually you're going to want to be shifting that to more of a pre-tax basis and trying to defer those taxes when you're in your highest income earning years, basically.
I love that point.
That's kind of where I look at it.
And so the big challenge I see with Roths is actually getting the money in. And Roth IRAs used to only have 2 ways. It was contributions and conversions, Roth conversions. And what a Roth conversion is taking money from a pre-tax 401k or IRA and then paying ordinary income to move it into the Roth. In the last couple of years, they've introduced the Roth 401k. So individuals can save into a Roth vehicle via their retirement plan, which is fantastic. I want to emphasize the point that you just made around early on in your career, you're most likely in the lowest effective tax rate you're ever going to be in. And so, this is where the math of Roth versus traditional to me is so important, because I think conceptually you hear tax-free growth, no required minimum distributions. Like, why wouldn't I want everything to go into the Roth? And my point is and this is one of those lessons around time value of money and compounding. The earlier we can get money into a Roth IRA growing completely tax-free, the better off we are. And that's a fantastic strategy. However, coming back to the point of if you are in a high bracket, let's just say now you're mid to late career, well, that may or may not make sense. And I think it's really important to understand the reason for that is the way that our tax code is structured. The U.S. has what's called a progressive tax code. So you pay 10% on the first X amount of your income, then you pay 12%, then you pay 22, then you pay 24, then you pay 32, then you pay 35, then you pay 37. So those are what are called marginal tax brackets, right? So each incremental amount is what you pay. When you're accumulating wealth, and when we talk about the option of a traditional versus a Roth, in order to put into a traditional, as Mike already pointed out, and if there's any takeaway you have from this podcast, it's you are saving at the highest marginal bracket. So if you're fortunate enough to be in the 37, you're saving at the 37. But if we talk about what we consume and how our taxes are actually appropriated, it is based upon our effective tax rate, which is the average of the progression of those marginals. So said another way, if an individual is at the top end of the 24% bracket, don't quote me on the exact number, I don't know it off the top of my head, but I think it's roughly $380,000. But their effective tax rate is 20.3%. Again, marginal rate 24, effective rate 20.3. So the point that I'm making here is while you're saving, you want to reduce the highest marginal. And the same logic goes into this Roth versus traditional conversation, because if you are consuming or putting money in on an after tax, you're putting money in at the exact same point. And so if you're looking at this example, if you're effective rate, what you pay, is the same as what your taxable rate is, then it makes no difference, Roth versus traditional, but that's not reality at all. And so the point that Mike's making is, while you're younger or your kids are younger, and let's just say you're in accumulation mode, the effective rate is probably 10, 11, 12%. Right? That's very typical for someone coming out of college and early on in their career. But then fast forward, you get to the later years of your career and your income is progressed, hopefully, right? And so now all of a sudden you're at that 20% level. Well, there's an inflection point that clearly happens where early on we should absolutely be saving in the Roth when our income levels are low. And then as soon as you get to those higher income levels, then you need to flip it over and start saving in the pre-tax, the traditional stuff. And so this is where I think the interface with a financial advisor is so important, even if you're only in the wealth accumulation mode and you don't have a ton of investable assets to have somebody manage money. If somebody only sees the value in a financial advisor in their ability to manage their money for them, then they really shouldn't hire a financial advisor, in my personal opinion. This is a fantastic example of some of the many, many things that we do for our clients and our clients' children, because there is a very definitive impact. The earlier we save and getting those savings appropriated in the right different buckets, that's where I see true value creation with having an advisor. And it's, I hate to say it, but it is math, right? Like, it's very formulaic in this regard, and we can make it as complicated as we want, but we can boil it down to just pure numbers. Now, the challenge, of course, will always be, what are we going to make from assumptions of growth? Like, what do we think future effective tax rates are going to be? How is the money going to be invested and growing at? But if there's advice that we could give, is that understand that there's a dynamic element associated with saving in pre-tax accounts versus post-tax accounts. It's not appropriate, in our professional opinion, to put everything in one account type. I think, under optimizing in the different structures can ultimately lead to less long-term financial success. And that's where I think it's extremely important to make sure that we're interfacing on not only how much are we saving, but where are we saving? And for anybody who's listened to my podcast, they've heard my terrible joke, but the financial advisor and us, we're going to have you save every dollar you make and leave nothing left to live. Just like we'll have you work to your 80, you die at 81, the plan's going to work great. Terrible jokes. But the point is the more you save, the more you're going to have. The longer you work, the more you're going to have. But that's not living. That's not life. That's not someone's long-term financial plan. Well, candidly, it might be for some people, but that's, not very typical for what we see. And so, it's the optimization that comes from that and making sure we're interfacing it with a financial plan. When I think about the stewardship of wealth, and we talk about, like, as we're working, as we're accumulating, one of the things I wanted to talk about was these accounts, when someone passes away, they go to a spouse, and spouses, for all intents and purposes, get the same rule as the participant. So let's just assume it's the same. But for anybody else, there's now a new set of inherited rules that comes with it. And candidly, IRA and Roth are essentially the same. But Mike, why don't you talk a little bit about what are the rules for an inherited IRA as well as an inherited Roth IRA?
Yeah, so essentially with the passage of Secure Act 2.0, they've eliminated what's called the IRA stretch provision. What that basically means now, that if an IRA is inherited by a non-spousal beneficiary, which, that covers a lot of people, but basically the IRA needs to be drawn down within 10 years.
Yeah.
If the decedent, the person who had passed away, was already taking required distributions, over those 10 years, you got to continue to take a little bit of a required distribution as well. But the bottom line is the whole account needs to be emptied out within those 10 years.
Yeah. The one thing I was going to point out is this rule went into effect in 2020. So if someone passed away prior to 2020, they still get what Mike mentioned was that stretch, which means that they can take out the account over the beneficiary's lifetime. But that's now gone. So anybody who dies, has passed away or dies in the future, will get this new 10-year rule. And, you think about it, this could actually create some economic implications as well. Let's just say that you're fortunate enough to pass away with $1 million IRA account or bigger, right? But let's just say it's $1 million. And for the economics here, when I think about it, Well, that $1 million, if someone's inheriting that, they're probably inheriting it at their peak earning years, right? Like, or we have clients even now that they're retired and we're doing all of this elaborate tax work for, and then all of a sudden mom or dad passes away and they've got this inherited IRA account now that they have to manage, which of course is changing the ability for all the beautiful planning work that we had done. And now it's a dynamic element that has now impacted what we were doing from a planning perspective. But what my point was with this is that, let's say, for example, you have a child, they're going to inherit in their late 50s, early 60s, they're in their peak earning years, they're already in the 24 or 32 or 35 or 37% tax bracket, and then they inherit this account. And even if they stretch it out over 10 years, that's an additional $100,000 a year that's at a high marginal tax bracket, right? So this is why I think tax optimization work is so important, especially in the context of if we're going to leave a legacy. Because we talk about things like Roth conversions. And why don't you describe a little bit, Mike, what a Roth conversion is and maybe a little bit why we would do it?
Yeah, so basically a Roth conversion is moving pre-tax money. So think again, pre-tax money in your traditional IRA, 401k into a Roth. And basically when you do that, you pay taxes up front. So remember, this is money that you got a tax deduction from. It reduced your gross pay, never been taxed. Essentially, you pay the taxes on it, move it into a Roth. Once it's in the Roth, it grows tax-free. Why would you do that? Number of reasons, but for the context of this conversation, it's around getting in front of those required distributions
Bingo.
that you have to take. James, you talked about it a little bit, RMD trap. I've seen that so many times where, clients come to me, at a later stage in life when they're older, and I've seen where they've lived off non-retirement money for pretty much their entire retirement. If they're fortunate enough that they've built up enough non-retirement money and they've not touched their pre-tax money, a lot of people think about saving taxes in the year. Like this year, how can I save taxes? Not how can I save taxes long term.
Yep.
And if you're focusing on just a year by year basis and you're building up this pre-tax pile of money, well, eventually you have to start taking some out. And in the first year, percentage-wise, it's not really percentages, it's based on mortality tables, but it comes to about 3.64%. So if you think about, if you have $1 million account, you grow it to $3 million. By the time you have to start drawing on it, well, suddenly that's 3.6 to 4% of a $3 million portfolio versus a $1 million portfolio. And that tax liability, and who knows what taxes will be by the time you're in your 70s.
Bingo. Yeah, no, and such a great point. And I want to emphasize, this is when we talk about tax optimization, it's looking at I love the way you framed it, but it's looking at the now and really manifesting what the future is presenting it. And this is why the integration of a financial plan with a tax strategy is so important. I've never seen one tax strategy like make or break a retirement plan, right? Like that's not what we're talking about here. But what we're talking about is the intentional decisions that we make over a multi-year period of time and the economic implication that it has long-term. Like Roth conversions create real and meaningful value. I mean, I was just looking at visiting with a client that we've been doing Roth conversion work for the last 8 years since they retired, and it has saved them well over $1 million in taxes over their lifetime, just by paying some tax now to mitigate the future. And they're fortunate that their portfolio, they're the exact scenario they described. They've got after-tax non-retirement accounts that they used to live off of, and these pre-tax were just continuing to grow. And by the way, with as much as we've done in these conversions, their pre-tax assets are still more than they were when they retired. There's a chunk of this that then comes over. The other benefit, though, I see with these Roth conversions is, especially if you're fortunate enough where you're leaving a legacy to your kids, coming back to that 10-year rule. That rule applies to IRAs, 401ks, and Roths as well. So these Roths still have to get drawn down over 10 years, but they're completely tax-free. So this is a great example where the work that mom and dad or grandpa and grandma might do and yes, it means that they themselves are probably going to be paying a little bit more in taxes, but the work that they do there, ultimately, it allows the assets to continue to grow on a tax-free basis. Yes, they're paying tax earlier on. I get that, right? That's an expense and that reduces capital, but the growth is continuing to happen in a very significant manner over a longer term period of time. And that does create real meaningful economic enhancement by doing these strategies, which is the exact reason why we're advocating for doing it. One final thing I wanted to address, and you can tell, we have some biases, and I'm going to emphasize, I don't want ever to see a portfolio that is 100% in any one of the different respective macro buckets. But if you're in the position where you can do some lifetime giving to your children or your grandchildren, as early as we possibly can, and I know we've hit this point already, but as early as we possibly can, funding Roth accounts for your kids or your grandkids is real. It's meaningful. And I talk about like the compounding time value of money, but the difference of someone starting to save in an account at the age of 21, when they usually don't have any discretionary cash flow and the ability to get money saved, versus just waiting 10 years. So just to put some numbers to it, if somebody puts the $7,500 in per year for age 21 up until the age of 60, they're going to have about $1.8 million saved. If they wait until age 31, again, $7,500 a year, so that would equate to $77,500 in absolute terms, like 10 times 7,500, right? But just by waiting, that 1.8 drops to $1 million. So it's $800,000, 77,500, right? And this is this concept of time value of money. But coming back to my point, if mom and dad or grandpa and grandma are in the position to be able to do some lifetime giving and helping, like I think about wealth creation and how we can really benefit the next generation, but by helping them fund things like a Roth contribution on an annualized basis, that's real, that's meaningful, that creates economic value. Again, it's an expense and it's cash flow, right? But it's one where having the impact in that someone's 20s versus waiting until you might pass away and they're now in their 50s or 60s, like it may or may not have the same feeling, right? So it's just an active conversation. And I think it's really important if you're interfacing with your financial advisor, they need to do it on an intergenerational basis, right? Where you're looking at the family holistically and how, again, we've talked about the IRAs and the inherited IRAs and how that interfaces, but even these things like lifetime giving, because we see the meaningful impact. I mean, I've been doing this now for almost 20 years and now I'm seeing like 20 years of compounded growth. Look what it's doing for some of these households. It's amazing. And it really does create economic value. Mike, I know this went longer than we anticipated. I'm sorry. It's kind of, but I really appreciate the time this morning. And thank you all for joining us for the podcast.
Thank you.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.